Hey traders, and welcome back to IFX, and today we're going to talk about the stop loss. This is another critical point that happens when we're trading, and that is going to be the stop loss, because then we get scared, the market is going against us, and we quickly get out, or we put a really tight stop loss, and we don't let the trade pretty much work out, and then we also start to lose more trades than often because we hit a stop loss very quick. So we have three different types of stop loss, very similar to our take profit on the previous video. And then we're also going to talk about the trailing stop, which is also going to be very interesting. Pretty much they go hand in hand. One of the things is that on the following videos, if you stay tuned and you like this video and you subscribe to the channel, one of the things is that I'm going to talk about what are the advantages and disadvantages of having a stop loss. And we're going to have a lot of examples showing same strategy, entry for everything, just that one is going to have a stop loss and the other one was not going to have a stop loss, and we're going to see the differences and which one is going to perform much better. So stay tuned for that, because this is going to be a very interesting video. But as of right now, we're just going to talk about the different stop losses that we have on the EA and what are they going to do, right? So just very similar to the stop for the take profit, we have a stop loss in pips. So again, you can choose, if you're choosing for take profit, if you like one of those people that like to do like 2-to-1, 3-to-1, or 4-to-1, if you take profit is 30 pips, then you want to then choose a stop loss of 10, so that will be a 3-to-1. You lose 10, and then hopefully you will win 30 pips, right? So that's something like that. So in here you put in a fixed stop loss, whatever target that you would like to do, whether you're scalping or whether you're actually a swing trader, you trade on a higher time frame. That is really up to you. And then we have also ADR percentage, which we talked about. That is is more beneficial having an ADR percentage, because instead of having a fixed pips for every single pair out there, we're gonna choose an ADR percentage, which is more calculated based on pair, differences, right? On pair average daily range, which if it's 100 pips for pound dollar, or if it's 60 pips for dollar CAD, for example, they both have different type of ADR, so the percentage is going to be different. Whether you put in 20% for both, is going to be totally different. So you can choose that as well, ADR percentage. And then we also now have the reversal block. Okay, so in here is not going to close us on an opposite block, because we already have that as a take profit. And on the take profit, it can either close as a profit or actually as a loss when you choose an opposite block. So in here is that if you enter on a reversal block or on a trend block, then it's going to stop you if the market or if the price goes above that, if it goes against you and above that reversal block, pretty much, but not above it. But if it closes above it, because sometimes we have the price where the price likes to go above a block, but if it doesn't close it, then pretty much the market is gonna keep going in the same in this direction that you had entered previously. So that's something that I'm gonna teach you. I'm gonna show you right now, but it's very simple. And trailing stop, right over here, there are times when trading stop, it is beneficial. There are times when it's not. So again, it's like, what's the best? And I always say it's 50-50, but if you choose this to be true, then what we do is in here is that, let's say you have a target of 50 pips, right? So you say in here, when you set this to true, you say, okay, if you reach to, let's say, 30 pips, move, and if you leave this to 0, then it's going to move just to break even and not move any further after that, right? It's gonna just stay at break even. So let's say the market just keeps on moving and might keep on going lower and lower to hopefully reach your 50 pips stop take profit, then it's gonna stay at break even. But if you wanna actually for the price to start moving after 30 pips to actually move into profit, then you have to actually divide this into in half. So If it's 15, if you wanted to move 30 pips in profit, then what you need to do is that after 15 pips, let's say you say move 15, right? But the first 15 pips is going to move to break even. Then after the next 15 pips, which is going to be a total of 30 pips, is going to move into 15 pips positive pips, right? So this is very important. So if in your mind you have that, if it says if you runs after 45 pips move in profit 15 pips, then it's not going to do it. First it's going to run 45 pips, then it's going to the first stop is going to be break even. Then after another 45 pips, it's going to move into 15 pips. So what you need to do is you need to break this in half in order to actually do what you initially wanted to do it. So, you know, break it in half, let's just say 25, right? Or 23, let's just say. That would be half, or more or less half of that. So if it moves 23 pips, the first initial 23 pips is going to move to a break even, and then after that, after another 23 pips, is going to move 15 pips in profit. So is it good and bad? Well, we're gonna see some differences, because after 23 pips it moved into break even, then the price might just take you out into break even and then maybe keep on going in your direction. That's something that you have to think about. Or if after 45 pips it moves into break even, then maybe if they eventually will take profit. And you know, I mean, it's a little bit more complicated, but just to kind of keep it simple, just know that after total pips gain, it's always going to initially move to break even, and then after another 45 pips, it's actually going to move to take profit, right? Move it to a positive pip. So keep that in mind. If you leave this to zero, it's just always going to stay in zero no matter what. So let's see what happens in here. So again, I'm gonna, like in the next examples, we're gonna do some videos on really the benefits, the advantages and disadvantages of having a stop loss or not. So in here, this is take profit of 30 pips and a stop loss on 10 pips. So we can tell, of course, this is no filtering on any strategy. This is just entering on plain blocks, right? So in here, we had a lot of entries entering on the block. So after 10 pips, it would just stop me out. Eventually here, this was the only beneficial one. So pretty much this one will be all break even, right? Because minus 10, minus 10, minus 10, and eventually did 30 in here. So pretty much this entry would have just been break even, would have been nothing. So right here, the same thing, 30 pips, 10 pips. Then in here actually gave me 30 pips. So let's just say for this day, ignoring this one right here, would have been only 20 pip net profit, right? So that's something that you have to think about when you're trading, when you put in stop losses. So we're gonna go more further in details into this. So when you put in a fixed stop loss, you just have to, it's just 10 pips. That's it. I want 10 pips stop loss no matter what happens. But sometimes it's beneficial to you and sometimes it's not. So that's the luck of the coin, of flipping a coin. 50-50 is gonna work, 50-50 it is. So it is very crucial when you put in a stop loss. It's like you're not letting the trade to work your way. Imagine if you would have entered, if you would have put maybe a better filter, of course, maybe you will have entered twice and then not put in a stop loss in here, and eventually what did the market do? It actually it went higher, right? It went to the previous high. And even this one right here, it actually would have been in profit on the next day. Of course, this is if the market does not have a strong trend, but this one eventually would have been in profit. Yes, it would have been a small drawdown, but that's something again that we're going to talk about later on some more videos. So this is just having a fixed stop loss and a fixed take profit, 3-to-1 pretty much. If you lose 10, you win 30, and that's it, something like that. Now in here, this is having a 30 pips take profit and a stop loss of using the reversal block, right? This is doing a reversal block. What does it mean? Is that like right in here, I'm going to just draw an example. This one right here is our reversal block. So if the price, let's say the enter right here, if the price goes back up outside of my block, but if the body of the candle closes outside of that reversal block, then it's going to take me out. But if for some reason the price just goes up and then it comes back down, it's not going to take me out. So it has these benefits because, of course, if it just went up but it doesn't it doesn't keep on going higher, it's great. But if the body of the candle goes way higher, it also could be bad. So it's just part of the game. It's just never we're gonna get something the best. But that's pretty much how it works. It's gonna be like that. So I have some there were some examples in here. This was the reversal block right over here, and as you're able to tell, right here, I know it's kind of tiny. There was a candle that closed right below it, and I make this a little bit bigger so you can actually see. You see how this candle before it just spiked through it, but it never closed. But unfortunately, this one it did close, and then eventually the market did kind of started going higher and higher. So this is what I was trying to tell you. There are times when the market does that, and then it just finally goes up into the direction where we were supposed to be going, right? So this is, pretty much, this is another example right here. This was the reversal block right over here, right? And then that was the entry. This was the reversal block, and then unfortunately this candle closed right below it, and then that's where my stop loss was. So that's what it means with the stop loss of a reversal block. So if you enter and it goes below that block where you enter, it's gonna take you out, right? It's gonna kaput, it's gonna take you out, and that's the end of that trade. Okay, so the next example is going to be trading stop. Okay, so right over here we have 30 pips, trading stop of 30 pips, move to break even only. So I don't have a stop loss in here, so I just put in trading stop. Pretty much, if it moves, like let's say this one moved down 30 pips, but I only had it to, my take profit was actually 30 pips. I'm not sure what actually didn't take me out. Could have been maybe my take profit was much higher. Maybe this is wrong right here. Okay, so actually my take profit is 40 pips. So right here, this I change it up. So it should be actually 40 pips in here, and my trailing stop is 30 pips. So if we reach to 40, then it will just get me out, and that's it. But since it never reached to 40, right, then it moved to break even, and then it moved up, and then it just stopped me out at break even. That's pretty much what this is doing, right? So right here, this is definitely, since I didn't have a stop loss in here, I guess we could do that as well, just a stop loss. Like right here, they all hit on my take profit, right? So that's pretty much it. So in here is a little bit differently, not using stop loss per se, so it's using trailing stop more or less as your stop loss, right? So if I go to the next example, which is also going to be 40 pips instead of 30, then if it reaches to 30 pips, I want it to move, actually 15 pips moves to break even, and then after another 15 pips moves 15 pips in profit, right? So this was the idea in here. So in here, it moved, in here moved 15 pips, but it moved me to break even. So, of course, my take profit was 40. So, of course, it never reached to 40. So it stopped me out. Then in here, it moved 15 pips, actually moved in total of 30. And then it stopped me out at 15 pips in profit, right? So this was not bad at all. It didn't get me out at 40 pips in profit, but at least I got something out of this trade, which was 15 pips, so not bad. And this one was actually a break even. So so-far we are good. We're winning, right? We're good. So in here, this is a nice 40 pip right over here. This one, this is an example of one of those trades that, hey, it takes you out and then eventually boom, it goes your way. So this is one of those unfortunate trades where it did go down 15 pips, right? It moved 15 pips, break even right here. took me out, and then eventually it went down, and more or less I could have gotten my 40 pip initial take profit, which unfortunately didn't do it. So that's the benefits of having one and not having one. You know, you miss out on some of them. Right over here, it moved down 15 pips, it moved me to break even, and then it snapped me out of that. So it never reached, and I didn't win on this one either, right? So that's the benefits of either you want to move just to break even alone, or if you want to like kind of move steps by steps, and then eventually hopefully it will reach to your initial take profit. And if not, doesn't reach to your initial take profit, then maybe you can get something out of it, right? At least some pips out of that. So moving it smaller and smaller pips could really sometimes maybe help you out in getting those profits, right? You know, locking in profits. So like this one right here, if I go back, you know, this is the best example. So it did move 30 pips. It didn't reach to my 40 because I wanted 40 pips, right? You wanted 40 pips no matter what the market did. Fortunately, the market only moved 30 and then it went against you. So you at least were able to lock in 15 pips, which is not bad at all. So that's something that you really have to think about. You know, that's a strategy. There's no way, there's nothing, you know, like I said, there's no way I can tell you which one is best, you know. Some of them work, some of them not one day or the next day. So it's something that you always have to pay attention to the market. And that's so on and so forth. So in here, another break even, you know, it moved down 15 pips. It went up again by 15 pips. And then eventually it went lower. So in here, you know, break even and break even. So you know, not bad, right? This is something that you have to take into account, how you want to move your trading stop, and if you don't want to have a stop loss. So again, it's something part of trading that is I think is one of the hardest things. You know, entering is the easiest part. Getting out either as a take profit or stop loss is the hardest part of trading. It's really the hardest part, really, I would say. So if you have any questions, please let me know. Let me know what is it that you use. What do you think of using, you know, fixed stop loss, ADR percentage, or reversal block, or maybe instead of using a stop loss, maybe you want to use trailing stop instead, you know, and then kind of let that market kind of work your way and something like that, you know, or close to straights or break even and then kind of not lose anything on that. It's up to you. Let me know what you think, what is best for you. And sign up on the Telegram channel, like the video, subscribe, and then I'll see you on the next video.